Yes guys, let's discuss about AS 11 now. Accounting for changes in foreign exchange rates. The heading of the standard, accounting for changes in forex rates. So let's talk about the applicability of the standard. All enterprises. One, two, and three, everyone is brought into the ambit of the standard. So let's discuss about the standard now. We'll talk about accounting for it later on, but let's come to foreign exchange rates. How do you normally denote an exchange rate? Exchange rate is normally denoted as home currency per unit of foreign currency. This is normally written as HC by FC, home currency by foreign currency. Home currency per unit of foreign currency is an exchange rate. Normally written as HC by FC. Regularly, what do we say? Dollar is 65 rupees per dollar, 70 rupees per dollar. So home currency divided by foreign currency. Now, two important terms that we have to discuss is home currency and foreign currency. What is a foreign currency? Again, an exclusive definition. Other than home currency is a foreign currency. I think you people are lazy, standards are even more lazy. They only define one part. The other one is other than this. So foreign currency is other than home currency, then what is a home currency then? Now, home currency cannot be defined as a rupee in India or something like that. What he'll say is, home currency is the currency in which financial statements are prepared. Normally in India, all enterprises will prepare in rupees, so we call that as a home currency. Not necessary always. Let's say I have a foreign subsidiary and for the purpose of consolidation, the holding company has requested the subsidiary to maintain its financial statements in dollars, though it has operations in India. So what happens? This subsidiary started converting everything into dollars and presented the financial statements in dollars. So though that subsidiary is in India, I'll still call it the home currency as dollar and the foreign currency is even rupee also. Got it? So whenever I'm talking about financial statements, the currency in which that financial statements are prepared is normally called as home currency. So as far as India is concerned, any Indian enterprise normally prepare in rupees. Well, there are extraordinary situations where they choose anything other than rupee, but in general sense I'm talking about. Now these exchange rates, we need to talk about something called as closing rate. One exchange rate that we have to discuss about is a closing rate. In short, we denote it as CR or capital reserve now. Closing rate is exchange rate on balance sheet date. Exchange rate on balance sheet date is called as closing rate. and an average rate, that is AR, can be denoted as a simple average of closing rate and opening rate. So it can be written as closing rate plus opening rate divided by 2. Now, normally when I have a trial balance, what are the accounts that you see in trial balance? All ledgers are summarized into a trial balance. That means a trial balance can have all real accounts, can have personal accounts, can also have nominal accounts. Now let me rewrite this. I'll start renaming these 3 as far as AS11 is concerned. All real accounts are now called as non-monetary items. They are called as non-monetary items. Personal accounts are called as monetary items. Item. Anything which is receivable or payable. Receivables are all assets, payables are all liabilities. They are receivable or payable in a fixed sum of money are called as monetary items. Be it a receivable or payable, it should be received from someone or paid to someone, so they are personal accounts. Take some examples for this. Debtors, creditors, receivable, payable. Payable. Bank and bank overdraft. You can have advances, which is an asset, and loans, which is a liability. You have prepaid expenses, outstanding expenses, so on. All these are personal accounts which are receivable or payable in a fixed sum of money. They can be now called as monetary items as far as AS11 is concerned. Obviously, then what should be a non-monetary item then? Always go for the exclusive definition. Since monetary items are already defined, non-monetary items are other than monetary. Your non-monetary items are normally classified into 2 ways. Non-monetary items are classified as those which are carried at fair value and carried at historic cost. Carried at historic cost and those which are carried at fair value. Non-monetary items are all real accounts, those which are carried at historic cost. They are nothing but tangible fixed assets. Your fixed assets and long-term investments are all real accounts which are carried at historic cost. Carried at fair value, the best example that you can take is stock. Stock is always valued at lower of cost or NRV. Non-monetary items are all items other than monetary items which are carried at historic cost or carried at fair value. Carried at historic cost are fixed assets and long-term investments. Carried at fair value are stock and current investments. This is a unique way of classifying trial balance as per AS 11. We don't use this classification anywhere else except AS 11. While we discuss about AS 11, I can split AS 11 into three parts. The first one is foreign currency transactions. The second one we discuss about foreign operations. And the third part we discuss about is forward exchange contracts. These are my three parts as far as the standard is concerned. Once we discuss about these three parts of the standard, that will bring us to the close of the standard. Foreign currency transactions, foreign operations, and forward exchange contracts. What is a foreign currency transaction? Any transaction which is denominated in foreign currency. Any transaction which is denominated in a foreign currency is called as foreign currency transaction. Purchase of machinery from US in dollars. Purchase of machinery from US in rupees is not a foreign currency transaction because the denomination of the invoice should be in a foreign currency. I borrowed in US. I am being an Indian enterprise. Financial reporting currency is rupee. I go and borrow in US. Since the interest rate is cheaper, I went and borrowed in dollars. So I received dollars from the borrowing. It is a foreign currency transaction again. Now, to call it as a foreign currency transaction, you need to see the denomination of the invoice. Now check your financial statements. If my financial statements are in dollars and I am borrowing in dollars, then the transaction cannot be called as a foreign currency transaction. If your financial statements are prepared in rupees and your transaction is denominated in dollars, then it becomes a foreign currency transaction. What is a foreign operation then? Foreign operations are branches in a foreign country. The branches in a foreign country. These foreign branches can be split into two types. Integral foreign operations and non-integral foreign operation. Integral foreign operations are nothing but dependent branches non-integral are called as independent branches. So this will give you dependent and independent branches. We'll discuss about foreign exchange contracts later on. Let's come to this foreign currency transaction and let's see how do we account for it. Because the standard is talking about accounting for changes in foreign exchange rates. Now, such a foreign currency transaction, it is denominated in foreign currency. Let's say for this example, let's take a smaller example. Let's say that we have purchased some machinery in dollars. So whenever we are talking about recording, then we will talk about initial recognition. So let's split between recognition and measurement first. Maintain two columns. Recognition and measurement. This is the crux of accounting, always talks about recognition and measurement. Recognition, first one, initial recognition. Initial recognition in the sense, what is the first time of recognition? The first date of recognition is the date of transaction. Initial recognition on date of transaction. Measurement, it should be using exchange rate on date of transaction. We'll see it with the help of example, guys. Relax. Subsequent recognition then. Remember, subsequent recognition should be done only for monetary items. Cannot be done for non-monetary or nominal items. Always only for monetary items. For monetary items only. We have two dates for subsequent recognition. The first one, balance sheet date. And the next one is settlement date. Balance sheet date, always use closing rate. We have seen what a closing rate is. Closing rate is exchange rate on balance sheet date. So whenever your subsequent recognition is on balance sheet date, use closing rate. My settlement date, whenever you're taking this, always take exchange rate on date of settlement. Whenever there is subsequent recognition, either I'm increasing or decreasing, there will be some exchange differences arising. Exchange differences arising on subsequent recognition should be charged to P&L. Exchange differences arising on subsequent recognition should be charged to P&L. Take down that carefully, guys. Foreign currency transaction, will understand that with the help of examples. Yes, guys. So let's understand this foreign currency transactions with the help of an example. I'll take two foreign currency transactions. First transaction is machinery purchased from Mr. X, or let's call it as X Limited. From X Limited for $500. Second transaction, let's say there was a borrowing of $200 from ABC Bank. Both of them denominated in dollars. Let's say it is an Indian enterprise, so both of them can be called as foreign currency transactions. Let's say the date of transaction there let's take it as 15th August 2014. On this day, either the machinery was purchased or the borrowing was done from ABC Bank, and on that day my exchange rate to be given should always be denominated as HC by FC let's take it was 50 rupees per dollar. Easier to calculate, guys. Don't go for the actual rate. Then how do we record this transaction? Machinery purchased from from X Limited. So entry should be debit what comes in machinery account debit to X Limited. What value? $500 into 50 rupees per dollar. Exchange rate on date of transaction, the first initial recognition. So 50 rupees per dollar, and the answer should be 25,000. He borrowed 200 million from bank. So I get bank account debit to ABC Bank. That's from whom he borrowed. 200 into 50 rupees per dollar is 10,000. Then comes subsequent recognition. For subsequent recognition, only identify monetary items. Machinery is real account. So it is non-monetary in nature. They are fixed assets. They are non-monetary items carried at historic cost. But X Limited is monetary item. It is an amount payable to X Limited. Similar situation, I have a payable to ABC Limited as well. So bank cannot be considered, ABC Limited can be considered. We have converted everything to rupee now. This is a payable now. Now check. Let's say my balance sheet date was 31st March 2015 and my closing rate, exchange rate on balance sheet date increased to 55 rupees per dollar. Now what happens? How much should I pay X Limited? $500. Now each dollar should be purchased at what rupees? 55 rupees. That means if I purchase each dollar at 55, to buy $500, I have to shell out 27,500. But how much is the liability to X recorded? 25,000. That means now I have to credit X. Already 25,000 was there. I'll credit it only by 2,500. That is sufficient. So already credit for 2,500, 25,000 plus 2,500 becomes 27,500. Now how did I get this? $500 into 55 exchange rate now. 50 exchange rate when he recorded, that will give you 5 rupees per dollar. Now there is a debit which should be written now which is not there. So this we'll call it as exchange difference, or to be put up in a much simpler way, this is an exchange loss. I'll call it as an exchange loss because I'm debiting it. Debit all expenses and losses. So since I'm debiting it, it becomes a loss for me. And I'm saying such exchange losses on subsequent recognition should be charged to P&L. So I'll record the entry as P&L account debit to exchange loss. Similar situation here. Here also ABC liability was $200. Now I have to pay him 55 rupees. That means I have to pay 11,000. But the credit is only for 10,000 monetary item, that is ABC Bank. Should be increased by 1,000 rupees. Again I don't know what to write on the debit. So I'll write the debit as again exchange loss since I'm debiting it. Or use your common logic sense. If it was 50 rupees, I would have paid 10,000. Now since it is 55, I am paying 11. That I am paying 1,000 extra. Whatever I paid extra is a loss. Oh, this is $200 into 55 minus 50. Exchange loss always charged to P&L. P&L account debit to exchange loss. Am I settling the transaction on 31st March? No. My settlement date is also a subsequent recognition. Let's say the transaction was settled. My settlement date let's say was on 15th of April 2015, when the exchange rate on date of settlement was 53 rupees per dollar. Dollar came down by 2 rupees beginning from balance sheet date. Now check. How much did I pay to cash? I paid 53 rupees per dollar for $500. 26,500. Whom did I pay? Debit the receiver. Who is the receiver? X Limited. How much? Whatever is the credit balance in X account. X account credit balance 25. X account credit balance 2,500. This will become 27,500. The entry won't tally. Because I recorded the liability at 55, I settled him only for 53. That means I am saving 2 rupees per dollar. That 2 rupees per dollar will be treated as exchange gain. Thousand. Similar way, you can record here ABC Limited or ABC Bank. How much is ABC Bank liability? 10,000 plus 1,000, total is 11,000. To cash or bank, I have to pay him $200. If I am settling each dollar at 53 rupees, then what I have to pay is only 10,600. Balance 400 will be treated as exchange gain. Again, that exchange gain on balance sheet date should be charged to P&L. Right? This is a fair example. You can record one example or both. No problem. Recording one would be sufficient, guys. Yes guys, if you've taken that down, there's a small exception that we have to see with respect to this balance sheet date. For a subsequent recognition on a balance sheet date, we said it should always be translated using a closing rate. But there's a small exception where he says that if they had no intention to settle the transaction at closing rate, then do not consider the closing rate. Let's say something like this. Let's say the transaction was supposed to be settled and it was outstanding that you have to pay now. My payment liability was $100. Initial recognition was at 50 rupees. Suddenly there was a temporary boost in the dollar value and it has crawled up to 80 now. But however, I know that I have no intention to settle the transaction when the exchange rate is 80. My intention was to settle the transaction when the exchange rate falls. My intention was to settle the transaction at a maximum of 68 rupees, not more than that. In such a situation, he says that you don't have to take the closing rate because closing rate is not the possible exchange rate at which the transaction is likely to be settled. So then do not consider the closing rate, then consider that exchange rate likely at which the transaction will be settled. If the transaction is not likely to be settled at closing rate, the transaction is not likely to be settled at a closing rate. If the transaction is not likely to be settled at a closing rate, my subsequent recognition should be at the rate or exchange rate at which the transaction is likely to be settled. If the transaction is not likely to be settled at the closing rate, then the subsequent recognition should be at the exchange rate at which the transaction is likely to be settled. So do not take the closing rate in such situations. Peculiar thing guys, an exceptional rule. Please remember such things. That will bring us to the end of foreign currency transaction guys. Now let's go for the second part, foreign operations. what about this foreign operations then? Foreign operation basically indicates a foreign branch, be it a dependent branch or an independent branch, which we normally call it as integral or non-integral operation. The main reason why we use AS11 in foreign operation is for translation. The problem is, let's say I have a branch in US, Indian company, Indian enterprise reporting everything in rupees. I have a foreign branch in US which is reporting everything in dollars. But when I have to present a set of financial statements, I need one set of financial statements. Now how do I combine now? I have to combine that foreign branch into the Indian enterprise. Let's say I have 1 lakh machinery, $10,000 machinery there. I can't say it is 1,10,000 rupees, not possible. Because to add it, I need uniformity in the currency. Now where is the uniformity in the currency now? Now, so I have to translate the dollar into rupee so that I can combine it with the home currency here. So this is what we require as far as the translation is concerned. Such a foreign subsidiary which is presenting its financial statements, or I'll say the trial balance in a foreign currency, should be rerouted or should be translated into the home currency, and then we can prepare one set of financial statements. So this translation, we call it as translation procedures. Let's try to put both the columns. Integral foreign operation, non-integral foreign operation. What are we here to translate? We are translating the trial balance which is prepared by the foreign branch. Trial balance, we know the classification. All real accounts are called as non-monetary items. Non-monetary items are again split into two types. Those which are carried at historic cost, those which are carried at fair value. Then the monetary items, which are nothing but the personal accounts. And finally, nominal items in the trial balance. Nominal items are exchange losses, incomes and gains. We have to check how to translate. The first part, that is non-monetary items carried at historic cost. This is the crux of for the translation, because this is the only point of difference between integral and non-integral. Rest everything, your translation procedures for integral and non-integral are same, except for the non-monetary items carried at historic cost. For an integral foreign operation, non-monetary items carried at historic cost should be translated using exchange rate on date of acquisition. While non-integral operations, I use a closing rate. Non-monetary items carried at historic cost, exchange rate on date of acquisition for an integral operation, and closing rate for a non-integral operation. Those which are carried at fair value, from here translation procedures are same. Those which are carried at fair value, exchange rate on date of determining fair value. Like I said, same thing applies even for non-integral as well. All monetary items apply closing rates, be it integral or be it non-integral as well. Nominal items, normally we use, according to the standard, it is exchange rate on date of transaction. But however, understand it's not so easy to do this. Per day, let's say I have 5 nominal transactions. At least you buy stationery, you go buy conveyance, petrol, everything is a nominal item. Such exchange rates on date, if I use exchange rate on date of transaction, per day if I have 5 transactions, 365 days, how many transactions, how many exchange rates, how many translations? So by the time I translate this current year balance sheet, it will be next year balance sheet date, which is not possible. So let's try to make this simpler. So instead of taking this exchange rate on date of transaction, I can also use alternatively use average rate. If this is impossible to do if it is impractical to do by exchange rate on date of acquisition, then you can use average rate. We don't even check, guys. Normally what we do is take average rate and continue solving. Same thing applies even for non-integral operation as well. Normally a trial balance tallies. Normally if I am talking about, any trial balance should actually tally. So the trial balance prepared by the foreign operation in foreign currency will tally. But if you translate each one using different exchange rates, if each one multiplying by different factors, it is not possible. A trial balance, if every item is multiplied with the same amount, let's say I multiplied everything with 10. So what happens? 1 0 keeps on increasing. My balance sheet will still tally. So if my multiplication of each item in the trial balance is with the same number, then the trial balance will tally. But here, I am not using the same number for the translation. So different exchange rates are used. That means your trial balance can never tally after translation. So since it does not tally on translation, it will give rise to some exchange differences. This arises in a trial balance. Such exchange differences in the case of integral foreign operation, transfer it to P&L. If it is a non-integral operation, then I'll put it to FCTR. Foreign currency translation reserve. These are your translation procedures, guys. We also adopt these values in branch accounting. Take down. Yes guys, still in the foreign operations itself, there could be a situation where an integral for an operation can be reclassified as non-integral later, or a non-integral being reclassified as integral later on. Let's say it was a dependent branch initially, so it was put under an integral for an operation. Subsequently, as the operations grew, it started being classified as non-integral because it started conducting its own operations without having any dependence with the head office. So from a dependent organization, it became an independent organization, moving from integral to non-integral. Vice versa is also possible, because if you have a non-integral operation initially and later on, since the raw material were being applied, were being available at a higher cost in their country, they are taking the help of a home enterprise to fund the entire product. So what happens? Earlier it was a non-integral operation, but now will become a dependent or an integral operation now. So whenever there is a reclassification which applies, let's see what happened. For first reclassification from integral to non-integral. Second one from non-integral to integral. When there is a reclassification from an integral to non-integral operation, what is the only point of difference between integral and non-integral? Only the fixed non-monetary items carried at historic cost. Remaining everything classification was always the same. Exchange rate on acquisition should now be translated using a closing rate. That is the only point of change. Non-monetary items carried at historic cost should be translated using closing rate. And exchange differences arising should be transferred to, what is it now? It is a non-integral operation today. Integral became non-integral. Non-integral foreign operation should be transferred to, exchange differences transferred to FCTR account, foreign currency translation reserve account. Whenever an integral foreign operation is reclassified as non-integral, then the non-monetary items carried at historic cost, earlier till then they were translated using exchange rate on date of acquisition, but now they should be translated using closing rate. The exchange differences between those two, exchange rate on date of acquisition and the closing rate, should be transferred to FCTR account. What about the second one? Non-integral became integral. Until then, we had closing rate. From now onwards, I need to start using exchange rate on date of acquisition. Let's say acquisition was long ages old back. Now today, until today it was a non-integral operation. I was applying closing rate when I was getting the data. But how do we get this exchange rate on date of acquisition? Somewhere long before it was, I don't know what is exchange rate on date of acquisition. So today, how should I treat this value? Then what he says is, non-integral operation, when it is reclassified as integral, again only that particular concept of non-monetary items only should be considered. Carried at historic cost. Should be translated using. Now since it is integral, what should I use? Exchange rate on date of acquisition I have to use. But like I said, it is not possible every time to get the acquisition. What is the exchange rate on date of acquisition? So it is not exchange rate on date of acquisition. I will change it, I'll make it simpler. I'll say it is date of reclassification. So the date on which it got reclassified from integral to non-integral to integral, take that exchange rate on the date of reclassification. For the purpose of translation, you don't have to take exchange rate on date of acquisition anymore. Earlier non-integral, now integral. Earlier exchange differences went into FCTR. Now I have an accumulated FCTR account, now it became an integral operation. Can I have FCTR under integral? No. Then what should I do with the FCTR? FCTR, what will happen? FCTR should now be transferred to P&L. Absolutely wrong. FCTR should not be transferred to P&L. Until disposal of foreign operation. So until that foreign operation is disposed, I'll still hold FCTR in the balance sheet even though it was an integral foreign operation now. Even though it is an integral foreign operation now, I will still have FCTR account. If it was earlier a non-integral operation, such FCTR will be transferred to P&L, but only at the time of disposal of foreign operation. This is regarding the reclassification of foreign operations from integral to non-integral, or the vice versa. Yes guys, the third part of the standard was talking about forward exchange contracts. Now we can't understand the forward exchange contracts in depth as such, but in simple sense I can say that forward exchange contracts are either held for speculation or for the purpose of hedging. This is what we treat as per AS 11. There is a particular accounting called as hedge accounting, which is necessary for us to understand foreign exchange contracts. Hedge accounting I'll discuss when I'm taking up AS 30 financial instruments. So I will not touch any part here. I'll take it up when I'm doing AS 30. What is a hedge accounting? There are 3 hedges. We'll go into the details there. Now let's come to the most important part of AS 11 called as transitional provisions. What do you understand by the word transitional provision? Transitional means something which is temporarily put in. For whatever particular reason it is, whatever is temporarily put in, I'll call it as transitional provisions. So, what basically happened was, long back, I'm talking about the period of 2007s and 2008s. The problem was there was a big economic slump as far as the US was concerned. So, the borrowing rate in US, which was earlier about 5% or 6%, came down to 1%, 2% also at that time. That was a time where Lehman Brothers closed down and there was an economic slump back in US. And at that point of time when the lending rates came down, Indians saw a good opportunity because we still had good fundamental businesses here. So we saw an opportunity and started borrowing everything in dollars. So that we wanted to pay a lower amount of exchange, lower amount of interest there. Now what happened over the years after 2006, 2007, after they have acquired this, 2011, 2008, 2009, 2010, we have observed that again US was emerging as a power and the dollar started strengthening again. From where it went down to 36 or 37 rupees per dollar, it went up to 50 rupees, 56 rupees and went on to 65 rupees as well. Now, at that point of time, whoever has borrowed in dollars, imagine his situation now. Let's say I borrowed $100. How much did I get? 38 rupees per dollar I got when I translated. So how much did I collect? 3,800. Today, if I have to repay, I have to buy each dollar at approximately 65 rupees, let's say. So to repay $100, I'll have to pay 6,500. I got 3,800. The balance 2,700 should be treated as loss. So much of loss, if it is put into P&L, imagine what will be the position of the P&L then. The income statement was completely drawn into losses. Operating profits, but once you drop the exchange loss into the P&L and you're gone. Now this became a problem now. To overcome this problem came this transitional provisions. This transitional provisions actually came into impact from 31st March 2008 actually. It came into impact then. And at that point of time, it was valid up to 2009. Changed to 2010. Changed to 2011. Again revised to 2012. No more revision for 1 year, 2 years. Now he directly made it 2020. So enough multiple revisions happened to this transitional provisions. Every year he was giving an extension for 1 more year, 1 more year, 1 more year. Now the transitional provision is applicable up to 2020. Up to 2020, you have this transitional provisions in place. Now, what does the transitional provision say? He says that 6th December 2007 is the date. From this date onwards up to 31st March 2020. Okay. From 6th December 2007 up to 31st December 2020, I'm talking about these 2 dates. If I have a long-term foreign currency borrowing, and such a long-term foreign currency borrowing was applied for acquisition of depreciable asset, non-monetary depreciable asset. Any fixed asset is always non-monetary because they are real accounts. So if I have acquired a non-monetary depreciable asset, I have used this long-term foreign currency borrowing for acquiring a non-monetary depreciable asset. What happens? This is a monetary item. If this is a monetary item, that means subsequent recognition always on balance sheet date. Subsequent recognition on balance sheet date at closing rate. So what happens? Always you observe that the exchange rate is increasing, or let's say even decreasing also. There is a change in the exchange rate. So whenever I have a subsequent recognition at closing rate, it might result either in an exchange gain or exchange loss. Talking about the treatment for this. Treatment number 1. Normally exchange gain or losses on subsequent recognition of a monetary item should always be charged to P&L. Now comes in a second alternative. Now he is pulling in a second alternative. He is saying that either you do this is what is normally given as per the standard, or you adjust it from the cost of the asset. So when there is an exchange losses always should hold debit balance. If they should have been charged to P&L, entry should have been P&L account debit to exchange loss. But here he is saying you write it as monetary, non-monetary asset account debit to exchange loss. That means I am increasing the value of asset by the amount of loss. Now you will say, then what if it was charged to P&L, then my profit is reducing. But if it is adjusted to the cost of the asset, the profit is not reducing. Then how come 2 different treatments? Absolutely wrong. The treatment is still the same. I'll tell you how. Let's say the cost of the asset was 100. Let's say the exchange loss was 20 and now my cost of the asset is 120. Let's say if the depreciation was at the rate of 10% per annum on straight line basis, earlier it was 10, now the depreciation will be charged as 12. Have you observed that there is an increase in the depreciation to the extent of 2 rupees? So what will happen over the life of the asset? 2 rupees extra keeps on debiting to P&L, but not in the form of an exchange loss, but will be in the form of depreciation. At the end of the day, 120 rupees completely should be written off to P&L. Here, how much is written off to P&L? Only 100. That means 20 extra is written off to P&L. That in the earlier case, we have already debited to P&L by calling it as exchange loss. So, when we have treated the 20 as exchange loss and charged it to P&L, asset will still show at 100. 20 rupees already debited to P&L. Depreciation will be charged to the extent of 100 rupees for the asset. So 100 rupees depreciation, 20 rupees of exchange loss, 120 debit to P&L. Here, 120 rupees, there is no exchange loss debited to P&L. It got adjusted to the cost of the asset. It became 120. Depreciation being charged is 12. Over the life of the asset, the entire amount to be written off to P&L will be 120. So it will be written of 120 only, but in the first case, if you are not adjusting it to the cost of the asset, the entire amount of exchange loss is going down in 1 year. But if you are adding it to the cost of the asset, it will go to P&L. But over the life of the asset, slowly in parts, it keeps on transferring to P&L. Every year, if I am transferring 2 rupees extra to the P&L, over 10 years, it will become 20 rupees again. Write down the very important statement. Option once exercised is irrevocable. Earlier, if it was an exchange loss, he said, okay, I'll add it to the cost of the asset. I don't want to charge it to P&L. Now you got exchange gain. No, I got exchange gain. Why adjusting it from the cost of the asset? I'll start charging it to P&L again. Because it was an exchange gain. That is not possible. He said, you use the option once, whatever option you are going with, you have to continue to subscribe with the same option. Option once exercise is irrevocable. With that, we come to the end of the standard, guys. This is AS 11 for you.